Hello friends, my name is Arvind Dang and I have over 42 years of professional experience in the various industries. I have keen interest in the subject of ethics in business and have authored a book on the ethics in the real estate and hospitality industry in June 2022. You can see my playlist on this YouTube channel titled as Ethical Processes in the Real Estate Industry, and there are 31 presentations related to my book. Considering the wider interest of the professionals on the subject of ethics, now I plan to focus on the topics which are of common interest to all the industry. So my first presentation today is on the developing KPIs for the finance and accounts professionals. What is included in this presentation is number one, how to develop KPI. There are 11 activities which have been proposed. Quantitative KPIs identified for finance and account function, 15 numbers. A mix of qualitative and qualitative KPIs identified for F&A, 15 numbers. A scoring model for quantitative and qualitative KPIs, a template of 30 KPIs put together, how to populate the KPI template with actual values, comparing of the KPI targets with actuals, a quantification model with 4 illustrations for scoring, activities that can adversely impact KPI fixing, and future references. How to develop KPI 11 activities. Number one is sharing of the corporate targets like profitability, sales numbers, market share, revenue from existing and new product services, technology acquisition, cost, capex, employee cost, overhead, etc. with the CFO. Design of the format, contents of the KPI with the inputs from CEO, MD. This is in this context of the KPIs for the finance and accounts, and hence I am limiting this sharing with the CFO, otherwise this will be shared with all the relevant HODs. Number 3 is identifying important KPIs based on the corporate objectives and external influences like customer demand, competitors, offerings, economy, statutory consideration, etc. Proposing initial KPI targets and measures by each HOD of the F&A function and review with CFO. That means within the finance and account function there are several functions like account receivable, accounts payable, GL, etc., treasury. So proposing of initial KPI targets by each HOD with the CFO, reviewing and modifying the and approving the F&As of the finance and account function by CEO, MD, putting up the measurement system in place like reports and dashboards, converting each functional KPIs into KRA, that means key result areas of functional team members at different levels, that is higher level directors, CFOs, HODs, general managers, and so on. Middle level senior managers, and managers, and so on and so forth. And lower level assistant managers, junior managers, or even the staff and workers if applicable. Now next point is periodic capturing of the actual accomplishment of the KPIs for each function using ERP and softwares. Periodic review of the actual achievement of the KPIs versus target. In exceptional cases, reviewing, updating and resubmitting the KPIs to the CEO, MD, and compiling level-wise actual versus target of the KRAs and forwarding on say 6 monthly or 12 monthly basis reports to the HR team for each level's mid-term annual performance appraisal review. Some examples of quantitative KPIs identified for finance and accounts professionals are profitability, which can be in rupees or USD or percentage, cash flows in rupees or USD or equivalent currencies, receivables in days or rupees, return on investment in percentage, solvency rated KPIs in ratios or percentage, and so on. These are listed in the following slides. For accomplishment of the target values of KPI in few finance and account functions is directly accountable, and in few it plays a facilitative and hence the indirect roles. Therefore, in the template proposed, there are two separate set of slides covering direct responsibility areas KPIs and indirect responsibility areas KPIs. A few examples of quantitative and qualitative KPIs. These are For example, IPO and equity related, long-term borrowings, investments, merger and acquisition and joint ventures, board matters, and so on and so forth. For accomplishing of targets values of KPIs in few of these F&A functions, as already shared, direct responsibility will be stated, and indirect responsibility will be stated, where the F&A will play a facilitative role. A scoring model for qualitative and quantitative KPIs. In the above type of KPIs, which are both qualitative and quantitative put together, it is very difficult to quantify the performance in rupees terms or percentage values or other units alone. In such a cases, a scoring model is proposed to have qualitative assessment of the performance on a 5-point scale as highlighted below. The score 5 indicates the highest performance, the score 4 indicates very good performance, 3 indicates good performance, 2 score indicates average performance, and 1 score indicates poor performance. The target value for each KPI is to be set up by the CFO in consultation with the COMD at the beginning of each financial year as per the unit of measurement indicated. Therefore, it is filled as a question mark right now in the template enclosed. Now, template for 15 KPIs where F&A function has got direct responsibility, and here I am proposing a total weightage of 63% out of 100. Now, here in this slide there are 15 rows, which three KPI rows have a weightage of 15, they each with having a score of 5, and 12 rows KPI rows with each weightage of score 4, so total 48 score, so adds up to 63. Now the first one, for example, the KPI is IPO equity rated. Now this will include the measurement accomplishment parameters will include pricing, road shows, percentage subscription, cost, equity, preference shares, issuance and inflows, and so on and so forth. These are the parameters on which rating needs to be done on a scale of 5. And here I have indicated here percentage weightage of 5, which you can see in the column. Now there are, as I am showing, there are 1, 2, 3, 4, 5, 6 columns. The column number 6 is the one where the target has to be set up, and here I am proposing a target of 5 itself. In the case of long term borrowing, the parameters for evaluation vis-a-vis KPI are borrowing rate or cost from the banks or FIs, covenants, kind of quality of the covenants negotiated, credit ratings received for bonds and debentures, percentage interest rate, inflows, disbursals, EMI payments, timeliness, and utilization of the funds received. This is also proposed on a scale of 5. In the column number 4, and percentage weightage is proposed 4, and target is also proposed 5. A merger and acquisition and the KPI number 3 is investments, which includes evaluation of the risk analysis, quality of the risk analysis, percentage return of the investment, choice in shares, bonds, debentures, mutual funds, and so on and so forth. Again, the scoring is proposed as 5, 5, 5. Merger and acquisition JV, this is the KPI number 4, which includes carrying out the due diligence, price negotiation, terms and conditions, statutory approvals, forex hedging, ownership control, etc. These matters which are of relevance to the signing of this JVs, and percentage royalty, etc. Again, here the weightage is, here the score is 4, and weightage is proposed is weightage is proposed as 4. So as I was mentioning that there are 3 KPIs with each weightage of 5. Here I am proposing a weightage of 4, and the target is 4. Board matters, which includes quarterly and annual results, dividends, corporate governance matters, audits, and so on and so forth. Again, the scale is unit of measurement is 5, and the weightage proposed is 4. Target is 4. KPI number 6. This is a cash flow from business operations during a specific period. Now here the computation is based on the inflows from the customers, interest received, dividends, rentals, etc., and outflows to vendors, employees, taxes, etc. Here again, here the unit of measurement is rupees or dollars, and percent which is proposed is 4, and target it has to be fixed by the CFO with inputs from the MD or CEO. Point number 7, KPI number 7 is cash flow from the investing activities. The earlier one was cash flow from the business operation. This is from investing activities undertaken by the company, and computation is based on the inflows from the sale of assets, intangibles, securities and divestitures, and loan repayments by the borrowers, etc. And outflow is for purchase of assets, securities of other companies, acquisitions, investments made, etc. Here again the unit of measurement is rupees or USD, and percent that is proposed is 4. Target to be set by the CFO. KPI number 8 is cash flows from the financing activities during a period, and computation is based on the inflows from sale of equities, stocks, preferred shares, bonds, etc. And outflow is for dividends, buy of treasury stocks, bonds, short-term debts, payments, etc. And here again unit is rupees or USD, and percentage is 4. Free cash flow from business operations, less net capital expenditure. Again unit is rupees, and weightage proposed is 4. And then KPI number 10 is cash burn ratio, which is a free cash flow during a specific period divided by the number of days during the period, and negative indicates the company can go into financial distress. Continuing the 15 KPIs with direct responsibility of the F&A. KPI number 11 is operating cash flows, which is cash flow from the operations divided by the average current liabilities, which is again a percentage or a ratio. KPI number 5 is solvency, which is expressed in terms of debt equity ratio, which is total liabilities divided by the total stockholders equity as a percentage or ratio with a weightage of 4. Liquidity, KPI number 13 is liquidity, working capital, current assets minus current liabilities. Again unit is rupees or USD as relevant to the company, and weightage is 4. And next again the current ratio within the subject of liquidity, which is current asset divided by the current liabilities, and weightage is proposed as 4. And target to be fixed by the CFO. Now here it is important to note that any ratio value exceeding 1 indicates a positive net working capital. KPI number 15 is operating cash flow to capital expenditure, which is operating cash flow divided by the annual capital expenditure, which is expressed in terms of percentage or ratio, and weightage proposed is 4. So for the 15 KPIs mentioned above, the total scoring is 63. Now I am turning to the template for the 15 KPIs where F&A have got indirect responsibilities. Here 7 KPIs have been proposed with a rating of score of 3 totaling to 21 score in the, you can see in the second row, and 8 KPIs have been proposed with the weighted score of 2 totaling to 16 scores, so total score is 37. This you can refer to this row number 2. Now let's talk about this KPI number 16, which is the first in this indirect responsibility areas. This is the liquidity quick ratio. Here why I am talking about the indirect is because there are other supporting team members like sales and distribution team, or manufacturing teams and others who contribute to this, and therefore it is treated as a indirect responsibility areas. So here the liquidity ratio or quick ratio is defined as cash plus short-term securities plus account receivable divided by the current liabilities. Here the quick reserves are those which are likely to be converted into cash within a short period of time, thereby excluding the inventories. And if the value is more than 1, it indicates that company's ability to meet its current liabilities without any difficulty. And it is expressed in the unit of measurement as times in this column number 4, and weightage proposed is 3, and target to be fixed. Profit margin, everyone knows that it is earning without interest expenditure divided by the net sales revenue expressed as percentage, weightage is 3. And next one is KPI number 18, gross profit margin, net sales revenue minus cost of goods sold divided by the net sales revenue. Here the percentage indicates how much every sale rupee is gross profit, and higher the better. PBT, profit before tax divided by the net sales. It has been defined like that. and percentage is the unit of measurement, and weightage is proposed as 3. EBIDT, earning before interest, depreciation and tax, divided by the net sales value. Again, it is expressed at percentage. KPI number 21 is expense to sales ratio, direct expense divided by the net sales revenue. Here again the unit of measurement is percentage, and weightage proposed is 3, and it measures the percentage of each sales rupee that goes to cover the specific expenses, and lower the better. And as you can see that there are different kind of expenses which are manufacturing, marketing, finance and other expenses. Therefore it is taken as a part of the indirect responsibility areas. KPI number 22 is return on equity, ROE. It is net income divided by the average stockholders equity. Please note that ROE measures the return on investment made by the firm's stockholders. Here the percentage is the unit of measurement, and weightage is proposed as 3. EPS, earning per share, is another KPI, and it is listed here, and here it is the weightage is proposed as 2, and here it is net profit or loss for the period divided by the weightage average number of equity shares outstanding during the period. And here one can refer to the accounting standard 20 for computing this. KPI number 24 is dividend yield. Again, dividend per share divided by the market value, again expressed as percentage, and weightage is 2. Return on assets. This is another very important parameter for measuring the performance. It is net income plus interest expense net of saving divided by the beginning total assets plus ending total assets divided by 2, which is the average of these total assets. And it actually measures the utilization of the assets to earn a profit. KPI number 26. This is return on financial leverage, which is ROE minus ROA, already defined earlier, and expressed at percentage, and weightage is given as 2. Account receivable turnover is very important parameter, and this is defined as net sales revenue divided by the average accounts receivable, and more number of turns indicates the account receivables are being collected more quickly, and it is expressed as turns, and weightage is given as 2. Days outstanding receivables, this is 365 divided by the account receivable turnover. Days, unit of measurement is days, and KPI number 29 is average vendor credit value of the accounts payable divided by the cost of goods sold into 365. This expresses number of days payable to the vendors. And last one is inventory turnover, which is the cost of goods sold divided by the average inventory, and it measures the number of times during a period that total inventory is turned or sold. How to populate KPI template with actual values. In the template, each of these 30 rows represent a KPI parameter along with the unit of measurement with different weightages for each KPI. For an easy to understand scoring model, in the weightage column 5, the total of all weightages of 30 KPIs in the last row must add up to 100. In the template on the right hand side of the column 6, an additional 7th column is to be inserted with name, actual value against KPI, and it is to be populated by the concerned FANT, duly validated by the CFO. This I will be showing in the next slide. And the actual measurement must be carried out accurately from the financial books using the database reports from Excel sheets or homegrown software or ERP as relevant before populating the column 7 in the template, and value must be vetted by the CFO. Now, comparing the KPI target versus actual, a quantification model with 4 illustration is being proposed in the next slide, and here 2 more columns are added to be proposed to be inserted after column number 7, which is the actual. That column number 8 is the score earned, and column number 2 is the basis of arriving at the score in the column number 8. Now, this score earned is to be determined as follows: actual value in column 7 divided by the target value in column 6 into weighted score in column. The computation of the score earned is illustrated below for 4 random KPIs, each with a different weightage of 5, 4, 3, and 2. That means they will be covering the spectrum of these 30 KPIs respectively. The values or numbers indicated in this illustration, whether it is target column or actual column 7, are absolutely hypothetical, and it's only captured for the purpose of easier understanding of the professionals. Now, let's look at this scoring model. Now, let's talk about the KPI number 1, which is IPO equity related, and measures I have already indicated. Now unit of measurement is scale of 5. Now weightage is given as 5. Now in the column number 1, 2, 3, 4, 5, 6, in the sixth column number 6, there is a target of 5. Now let's assume that the CFO has given a assessed that overall performance on these all these parameters, whether it is a cost, whether it is a subscription, whether it is a timely issuance of the preference and equity shares and inflows from the subscribers. Let's say the rating is given as 4. Score earned in column number 8 is 4, which is based on overall assessment, which is very simple in this case. Now let's go to KPI number 6, which is the cash flow from business operations. Now I have already shared what inflows come from where and outflows go to whom. Now here let's assume that in column number 6 the target for the cash flow for a specific period was 80 lakhs rupees, 80 lakhs, and let's assume that the actual is 60 lakhs. Now the weightage is 4. So here the computation, if you could please refer to the last column, column number 9, it is 60 lakhs actual divided by 80 lakhs target multiplied by score weightage of 4 in the column number 5. So total score is 3, which has been put in this column number 8. Now let's talk about KPI number 16, which is liquidity quick ratio. And I won't go into the definition of this. Now let's assume that the target here was 1.10, which is supposed to be a good one, and let's assume that the cash for a period is 6.2 lakhs. I'm talking about the actual. The short-term securities is say 4.1 lakh, and let's assume that account receivable is 8.6 lakhs. So total divided by 22.2 lakhs becomes 0.93. So the scoring against the weightage of 3, the score earned is 2.54, which is based on the actual value of 0.93 as shown here, and divided by target of 1.10 multiplied by weightage of 3, which is equal to 2.54. So account receivable turnover, let's assume that the target was 9 tons, and let's assume that the sales in the column number 7, let's assume that the sales value is 68.20 crore divided by the average account receivable in the beginning and the end of the period, which is 915 lakhs and 1125 lakhs. So total receivable is actually 6.6 tons. So the score earned is 1.46, which is 6.6, which is the actual value divided by the target value of 9 multiplied by the score in the column 5. So it is 1.46. So there you will please find that for this 4 random KPIs, the total target was 14, whereas the actual score earned is 11. In the last row, this is what I am showing. Now comparing KPI targets, continuing. Now here KPI targets will undoubtedly vary from organization to organization, and weightages can be decided by the CFO in consultation with the CEO and MD. Therefore, at the absolute discretion of the CFO can do the following: change the character and the narration of the each KPI and its measurement unit, add or delete or edit the KPI in consultation with the CEO, MD, and if required with the HR team, change the proposed weightage of 5 or 4 or 3 or 2 for KPI to any other number. Supposing the number of KPIs, let's say hypothetically it is not 30, let's say it's 20. So therefore the weightage will obviously change. It could be 5 or 6 or 7 or 10 and so on and so forth, or different, but the total must add up to 100. In the large organizations with multiple plants, offices in different countries, states, locations, or companies with multiple and products or services, separate KPIs must be identified for each sub-function of finance and accounts. That is for separate KPI for the treasury, for the corporate services, for the account receivable, for the board matters, secretariat function, etc. etc. So CFO can evolve KPIs for above functions based on the similar approach with focus only on the relevant KPIs for each function. For service industry, KPIs related to inventory will not be relevant in this case, and end product will get replaced by the services, and cost of goods will get replaced by the cost of rendering services. Now, what are the possible unethical activities which can take place or which can adversely impact the business? Now, here, number one is providing incorrect inputs to the senior management, CEO, CFO, CEO, MD with malice intent of assigning easy targets and goals for the KPI parameters. Number two is in the workflows embedded software that enables accessing of the KPI, incorporating incorrect parameters vis-a-vis the management approved parameters by not exercising prudence, leading to inaccurate capturing of the KPIs. Making changes in the KPI targets or actuals before performance review period with the ulterior motives. These are all unauthorized changes. Measure of accomplishment are deliberately kept vague and not merit based, leading to the scope of manipulation. Percentage weightages assigned to each KPI are biased with ulterior objective of influencing the outcome vis-a-vis performance perspective. Target sets are biased. That means these are too stretched or too loose depending on the function for which this is being assigned, and to reprimand or favor specific team levels employees, leading to demotivation and dissatisfaction. The next point is the actual measurement carried out is captured inaccurately or manipulated. Through the back end of the software, ERP making circular changes in the KPI targets or actual just before the performance preview period with ulterior motives and turning off the audit trail to prevent retraction, and in fact going back and reversing the circular change. Not ensuring restricted access rights to KPI values in the appraisal software, in thus enabling unauthorized persons to make unauthorized changes in the target versus approved KPI. Way forward. The above presentation is primarily for the conceptual understanding of the KPI development process. The number of parameters for the KPI can be altered at the absolute discretion of the organization. Usually, KPI is coordinated by the finance and accounts and HR team, but each HOD of the function must prepare the KPI document directly. The KPI prepared by each HOD must be reviewed periodically by CFO, CEO, MD for enhancing the performance of the business. Once KPIs are ready, management should convert these into the individual KRAs, key result areas, for each hierarchical level within each function, depending on the responsibilities associated. KRA targets versus actual YTD data can serve as a useful tool by the management in the annual performance appraisal system, and this will be covered in more details in my next presentation. Now, these are the reviewing resource requirement. Having these KRA targets can help the following: reviewing these resource requirements including financial, technical, manpower and project monitoring software, managing bottlenecks on the timely basis with the CFO, annual appraisal of the CFO, each HOD and supporting teams, enhancing the profitability and delighting the stakeholders. These are the benefits of going for this KPI and KRA. This contents of this presentation are from one of my chapters from my upcoming book on various topics related to the finance and accounts function. This book is expected to be released sometime in the next few months. You can read also about this in my blogs mentioned below. This book is the second in series to my first book, which I have already shared, and book is available. The earlier book is available on the Amazon, Flipkart, and few retail outlets in India. And there are several blogs which and YouTube videos. And as of within 1 year, there are more than 500,000 views or clicks, which you can see. Now I have given the references of my links: YouTube, blogs, Facebook, and LinkedIn. Thank you very much.